I think that 10-year yield is going to retest 5% at some point this year and probably go through it. And that's not all for good reason because the economy is robust. It's because we're in a more stagflationary type of environment. The biggest risk out there is just these higher interest rates. Like I said, it's going to be good for some, no doubt about it. But we have a very levered economy, and a very levered economy married with much higher interest rates relative to where they were for 15 years pre-2022. That there's going to be more issues to come.
I'm pleased to be joined today by Peter Boockvar. He is a CIO at Bleakley Financial Group and the editor of the Book Report. We'll be talking about his views on the markets, his preferred asset classes this year, and his outlook on economic growth and what the Federal Reserve may do next. This episode is sponsored by NordVPN. Peter, welcome to the show. Good to host you today. Thanks for being here.
Thanks for having me, David.
Let's start by talking about data release that came out today on Thursday, April 25th. GDP came in lower than expected. Markets didn't react well. Stock markets in particular initially didn't react very well to the news. Currently down about 0.5% on the S&P 500 as of market close. Is the economy slowing down faster than expected? Is that what's going on?
No, there was some mixed pieces to the report. Consumer spending that rose nicely 2.5%, but that was less than expected. From everything that I see anecdotally from company earnings calls, from a lot of diffusion indexes and some hard data here and there, it doesn't feel like a 2.5% economy. It feels like a 1.5% type economy. And I think the GDP number reflected that. Now, like I said, there's obviously other influences, government-induced incentives to build factories, to make batteries and chips. That's also helping to lift spending. Residential real estate saw an improvement. What the market did not like, also in addition to the less than expected number, was a higher than expected PCE inflation figure at the core level within that data point. So that's why you had the 10-year yield getting back to 470 and the 2-year yield at 5%. Then, of course, you throw in Meta and what that meant for a bunch of stocks. And it all combined for a sell-off. But we did rally well for those. And after the market closed, Microsoft and Google looks like they had good numbers. So we're at least bouncing after market.
With the PCE data coming in harder than expected, Peter, has this more or less eliminated the chance of a cut by the summer, you think?
I think the Fed will cut only if the unemployment rate goes above 4%. Powell has spoken a lot about having confidence in getting closer to the 2% inflation level, or at least the trajectory. But that trajectory has stopped. Commodity prices are at near multi-year highs. So I don't know how he would have any confidence in cutting just yet. But like I said, if the unemployment rate goes above 4%, I think he would more lean to that being a focus and less so on inflation. Either way, we're barely going to get any cuts this year. And higher for longer interest rates is a real thing that I think people have to come to terms with. That benefits some and it hurts others.
Beginning of the year this year, I remember the equity markets and bond markets also were pricing in at least 4 to 5 cuts, some even say 6. Have markets more or less adjusted to the new reality of no longer 6 cuts by this year? Do you think we've accurately priced that in?
Well, the bond market has. The bond market is only pricing in 1 this year and about a 35% chance of a second one. So that clearly has adjusted. I think the stock market's still trying to juggle what that means for multiples and economic activity and so on. It's still holding out hope that everything's fine because if the economy slows down, the Fed will cut and everything's going to be okay. I'm less sanguine about that. And I think higher interest rates for a while really does matter and not necessarily in the best way. Particularly for multiples that are still pretty stretched right now in parts of the market.
Higher rates for longer, what does that mean for the economy?
Well, it depends on who you are. If you're a savior, if you're a baby boomer that has a lot of money in T-bills, you're doing fine. You really don't care about anything else other than collecting your 5% interest income on top of Social Security. And for the first time in 15 years going into 2022, you're actually benefiting and getting return on your savings. And we're seeing that reflected in the travel numbers. You saw that from Royal Caribbean that talked about a pretty robust quarter that they had. On the other hand, if you're a borrower that has debt coming due this year, well, considering that you probably priced it before 2022, you're going to have to adjust to a much higher interest rate, and your interest expense is going to go up, whether that's in commercial real estate or a small, medium-sized business that has floating rate debt. If you're looking to buy a house and you're a first-time buyer, well, you're faced with a near 7.5% mortgage rate on top of a 45% increase in the average price of homes. If you're trying to buy a car, you're talking about an 8 to 10% interest rate on buying that car. So it all depends on who you are in terms of whether you're a borrower or a lender. And that's why there's a lot of bifurcation within the economy. It's not all strong, it's not all weak. There are pros and cons or puts and takes like I've never seen in the economy before.
What if you're a bond holder? Let's take the TLT, for example. The TLT ETF has not done well this year as the 10-year continued, where even the long end of the curve has continued to go up. Peter, what's your outlook on yields, especially in the long end of the curve, irrespective of what the Fed does? Can we expect to see the 10-year continue going up?
Yes, I've been bearish on the long end for years now, post-COVID, and have been much more comfortable owning short duration treasuries along with short duration investment grade bonds. I just don't see the reward in buying long-term treasuries. I think that 10-year yield is going to retest 5% at some point this year and probably go through it. And that's not all for good reason because the economy is robust. It's because we're in a more stagflationary type of environment. It's because yields are going up across the world. It's because the Bank of Japan may raise interest rates again. And the reason why I bring the Bank of Japan into this is because we're sort of very correlated in terms of global bond markets between Europe, Japan, and the US. So when rates go up there, they go up here. And I attribute the rise in the US 10-year last late summer into the fall from 3.75, call it 380 up to 5, right after the BOJ widened yield curve control or essentially eliminated it, even though it wasn't official. And that stoked an entire rally in yields or rise in yields across the world. And I don't think that the worries about U.S. debts and deficits have gone away. I think that is something that's real, and that will keep longer-term interest rates elevated because we know short-term interest rates are more tied to what the Fed is going to do. And I don't think the Fed is going to be raising interest rates at all from here. And but we've seen this back up in the short end because they're obviously not going to be cutting to the extent that the market was expecting or hoping for.
With the end of the Japanese yield curve control program, and their tapering of buying of foreign bonds, does that present a liquidity problem for U.S. Treasuries?
Well, potentially, yes. We've seen definitely bouts of illiquidity. Now, of course, it's a massive market. There's always buyers and sellers. It's just a matter of what price and how tight that bid offer is. I think at times in dislocation, that bid offer widens out. But it's also a regulatory thing too, is the Volcker rule definitely hamstrung a lot of big banks in how they can make markets. So it's a combination of factors, but there's no doubt that there's records amounts of supply, but there's been record amounts for 40 years now. Just a matter of if this record amount overwhelms the buyers. And I do think it's mattering on the margin, particularly since the Fed is essentially selling treasuries. Foreigners, while they're adding treasuries as a percent of total marketable securities, that percentage has shrunk a lot over the last 10 years. And also banks have limited their duration exposure because of the blowups a year ago.
I think now is a good time to segue into your economic outlook. So you said earlier, your words were that yields are not up because the economy is particularly strong. I believe that's something that I'm paraphrasing here. Well, what indicators are you looking at? I'm getting mixed signals from different people I'm talking to, depending on how they look at different indicators and depending on how they evaluate the health of the economy. Where do you stand on this debate? Are we getting a recession? Are we getting continued growth?
Well, as I said, it's a very bifurcated economy. If you are trying to sell an existing home and you're a real estate broker, well, business is pretty slow. In fact, that the pace of existing home transactions is near a 30-year low. So that area of the economy is in a recession. If you're building new homes, you're doing better because obviously the market needs more supply. If you're a low-end consumer, you're feeling your own personal recession because of the cumulative rise in inflation that maybe at best your wages kept up with, but you saw no real wage progress. If you're a higher income consumer, you're benefiting from, like I said, higher interest income, and you're also benefiting from owning stocks. And if you own a home, well, the value of your home just went up a lot over the last couple of years. So those people are spending more freely. If you're trying to sell stuff, aka goods, you're probably selling less than those that are selling experiences and services. If you're in manufacturing, you've been in a recession for almost 2 years now. If you're building manufacturing plants in the Midwest that are going to make batteries, you're doing fine because the government has incentivized all that construction. So it all depends on where you are. And I think there's a lot of mixed pieces of the economy that makes it hard to sort of make this blanket statement: the economy is strong or the economy is weak. There are pockets of strength or pockets of weakness.
And I guess this divergence or bifurcation of the economy can be reflected in the stock markets as well. Certain sectors, I'm assuming, correct me if I'm wrong, would do better than others. And we're not looking at a broad market, either sell off or rally from here.
Well, it's rare that you have neither, and you just flatline. I mean, I think that the market came out pretty strong this year with a 10% rally in the first couple of months. That was unsustainable. I think what stopped it in its tracks was this backup in interest rates. I've been more worried about a sort of a death by a thousand cuts economy that takes time to digest these higher rates. And I still think that is to come because there's still a lot of debt that comes due, whether it's in commercial real estate or it's in the corporate bond space over the next couple of years. And even for the US government, that has an enormous amount of debt that matures in the next couple of years, and why interest expense for them is going to head to $1 trillion. So it's really tricky. And even in the stock market, it's been very bifurcated. I mean, small stocks, generally speaking, have been left for dead. A lot of them, though, don't make money, and a lot of them are more subject to floating rate debt exposure, and they've seen a sharp rise in their interest expense, and they haven't termed out their debt like bigger companies have. Bigger companies, though, it's a mixed bag for them. If they're doing business in Europe, they're not seeing much growth. And they're doing business with China, they're not seeing much growth. But doing business in the US, maybe they're seeing some better growth. So, like I said, tremendous amount of mixed bags. You have India that saw an 8.4% Q4 GDP increase, but that China's economy is slowing down, notwithstanding their printed 5-ish% growth rate. You have Germany in a recession, but hopes maybe they're coming out of it. So it's you really got to do your homework on this economic situation, not just domestically, but globally, and really pick it apart and slice and dice it to get a better feel of how to use that information from an investing standpoint.
Okay. Domestically now, the corporate earnings season, people are looking at whether or not companies are able to sustain rates for higher for longer. Do you think we're going to see either restructuring or layoffs as a result of the Fed not lowering rates anytime soon?
Well, those over-levered balance sheets are certainly getting exposed, and we've seen the notable pickup in bankruptcies. But again, it depends on how your balance sheet is. Bigger companies, like I said, have termed out their debt. But that debt does come due over the next couple of years, so they have to be able to absorb that. So, balance sheet homework is really important in this environment, and how exposed companies are to floating rate debt, how much, and if they are, how much have they hedged it out? What's the maturity wall that you have in the coming years? Because the days of zero rates are over. And this isn't when I say a new environment, it's actually the historical environment. Interest rates, if you take a step back over the past 50 or more than that, post World War II, you can say, well, this is where rates should be. And I agree. The problem is that rates in the 15 years going into 2022 were not real. So there's going to be always a indigestion phase going from zero rates to 5.5% rates in a very short period of time, that while over time it's a good thing to have more normalized interest rates relative to inflation, I still think it takes many years of adjustment to that.
Which sectors have historically performed, I guess, better than average during a stagflationary environment?
Commodities usually have performed the best. If you look at the 70s, for sure, they well outperformed the general market. whether it was energy stocks, precious metals, even agriculture, industrial metals. So that's where we're positioned uh, in the markets as part of our overall portfolio for clients.
One thing we haven't discussed yet is the possibility of a rate hike. If the Fed were to really double down on being aggressive with getting down to the 2% target, is that in the cards?
I doubt it. I doubt that they're going to do that. I think that they're comfortable with the current level of interest rates, particularly relative to the rate of inflation. If they think that inflation, where they look at the PCE, but I look at the CPI, but call it 3% if you average the two, uh, I think they're pretty comfortable with 300, or I should say 250 basis points of real interest rates, which historically that used to be normal, was to have real interest rates above the Fed funds relative to inflation of about 250. So I think they're just going to sit tight because we have to also keep in mind that keeping rates high for a while is itself a form of monetary tightening because every day somebody's loan's coming due that needs to reprice. So I don't think that they need to raise again to further enhance the tightening and get to the point where they want. Now, granted, that would be another form of tightening, but I don't think they need to go there.
There's talk that they might taper the taper, which is to say that slow the quantitative tightening program. Are they starting to move towards easing once again? Peter, is that next?
No, Jay Powell specifically said when he talked about tapering fairly soon, is what he said at the previous meeting, which I guess would imply next week. He made it a point to say this is not taking our foot off the tightening pedal, because while they may cut the pace at which they shrink their balance sheet, they may elongate it as well, which the net result may be the same level and size of a balance sheet, the same level and size of bank reserves that they were going to get to anyway, but just stretching it out over a longer period of time. Now, whether they get there or not, who knows? But I think Powell is going to really be emphatic that this is not a form of easing by tapering QT.
Okay, moving on to your market outlook now, Peter. The S&P and risk assets overall have taken a breather from their top week and a half ago. Is this just a pullback, people taking profits, or is this the beginning of a longer term trend in a bear cycle, do you think?
It's really it's been very confusing, the markets, because we've been able to sort of catch a second wind thanks to AI, even in the face of higher interest rates and the Fed not really going to be cutting. So I would say that the rally being so aggressive in the first part of this year probably pulled forward most of the returns this year. Now, whether we fall or not, we'll have to see. We'll have to digest the earnings we've seen so far. Earnings overall, the stock market reaction to a lot of company earnings has been pretty poor. Even if you've beaten numbers, you've been taken out to the woodshed. So I think we'll have to see how we digest these tech earnings and Microsoft and Google after the market, how we're going to digest Amazon and Apple as well, in addition to others. But I wouldn't be surprised if the highs of 5250 end up being the highs for a while, as again, like I said, we probably pulled forward some returns. And when the market's trading at 21 times earnings and interest rates are relatively high, there isn't much room for multiple expansion under that scenario.
The Magnificent Seven stocks that performed really well last year, many of them aren't performing well this year. Would you say that this is sort of the end of the tech rally for the big ones, at least?
Well, there's certainly a splintering. I mean, I think rightly so. Each company is now being judged on their own fundamentals rather than just in a blanket investment decision. Tesla's being isolated based on their auto business. Apple is being isolated depending on the slowdown in their smartphone business. Obviously, Meta, Microsoft, Google, and Amazon have something in common in terms of all the AI spend that they're doing and how they're going to integrate those tools into their business. But as we saw with Meta, it cost a lot of money, with the returns in the short term being very uncertain. And Zuckerberg said that again in the conference call last night about the uncertain timing of when a lot of the spend was going to generate revenue. It's great for the picks and shovels people like NVIDIA, But in terms of CapEx spend, there's an enormous amount of it going on with uncertain returns and returns on investment of what this will end up being. And
Okay.
we know these stocks have been carrying the market on its shoulders, and we just have to wonder how much longer it can do that and whether the baton gets passed to another leadership group or it means that maybe there's more work to be done with this bear market if
Meta,
we are in one.
yeah, you brought up Meta. It slid on earnings. Alphabet just today jumped 14% on earnings beat. What are the tech companies doing right now to differentiate themselves from their competitors? Everyone's jumping onto AI in some form or fashion. Everyone's everyone has their own strategy for potentially moving into the metaverse. We're not seeing that yet take fold, but what's your take on their strategies going forward?
Well, it's we have to see whether all this spend is going to generate the returns that they hope for. I mean, when you think about it, AI, from my perspective, obviously is a tool that they're integrating to enhance the experience of the user, whether it's Google trying to enhance the value of search, whether it's Meta to enhance the value of Instagram and Facebook and so on, and obviously Amazon trying to enhance the search for products via AI. But they've been doing this since the history of their businesses, is always trying to improve their technology and using software and everything else to enhance their businesses. So to me, this is just a very expensive way to further enhance their business. Whether all that spend is worthwhile, we'll have to see, because right now it really is an AI spending arms race where you wonder if this is all going to get sort of commoditized. Now, there's no doubt there'll be a lot of productivity gains from this, but that's what technology does. It's supposed to enhance our efficiency and productivity and everything that we do. And I think this is just another form of that.
I watched a clip of Sam Altman of OpenAI give a presentation to a group of VCs in the room, and somebody asked him, "What's your plan to generate revenue with AGI?" He's developing artificial general intelligence. He says, "Well, we don't have one, but once we make the AGI, we'll just ask it how to make revenue."
So sort of amorphous, but it is a business. So I'm just wondering, like, eventually, is the idea to kind of like license technologies? Will you have customers and you're going to be customizing algorithms for them, or how is it going to work?
The honest answer is we have no idea. We have never made any revenue. We have no current plans to make revenue. We have no idea how we may one day generate revenue. We have made a soft promise to investors that once we've built this sort of generally intelligent system, basically we will ask it to figure out a way to generate an investment return for you.
Well,
We're gonna.
they really sell, subscriptions. I mean, those that create these models can sell subscriptions like Microsoft sells Office 365. But a lot of these companies are developing their own models that they want to sell, and Meta, in fact, is doing open sourced. So this is going to be a highly competitive space that'll be great for the user. You just have to wonder whether all the money that the producers of them are sinking into it, whether they're going to make a good enough return on that investment that would make it worthwhile for them. Because you even have a lot of scrappy companies, smaller ones, that are trying to develop their own large language models. So there's going to be a lot to choose from a user perspective on what generative AI source you want to use.
Okay. Finally, before we close out the conversation, Peter, let's talk about some geopolitical risks. Are you looking around the world any hotspots that may be a red flag to you, in the sense that you're looking at something develop and then you're going to have to discount some valuations on your own holdings because of those developments?
Well, obviously, geopolitics is always something we pay attention to, but historically speaking, it's rare that it has a long-lasting impact. Can things blow up? Of course. Sorry to use those words. Can things escalate maybe in the Middle East? Could things get bad with Russia? And we see oil prices spike for sure. But I do think that the biggest risk out there is just these higher interest rates. Like I said, it's going to be good for some, no doubt about it. But we have a very levered economy, and a very levered economy married with much higher interest rates relative to where they were for 15 years pre-2022, that there's going to be more issues to come, whether you're a private company or a government, that I think we need to pay attention to, and that long rates, in my opinion, still are going to go higher, and that's what I'm most worried about is sort of central banks and the Fed, losing control of the long end of the bond market, and I watch out for that.
Can you tell us a bit about Bleakley and your strategy there? Tell us about your products, any overweight or underweight biases you might have right now.
So Bleakley Financial Group is a wealth management firm with about 55 different financial advisors, which I'm the CIO of, and I portfolio manager on 2 strategies of mine. Like I said earlier, I'm slanted to having outsized exposure to the commodity space, particularly precious metals, energy, ag, and industrial metal stocks. I do think that there is a commodity bull market here. I do think that inflation overall will remain persistent at the 3 to 4% level. We're not magically going to 2 and staying there. I think that that's unrealistic. Now, of course, there are going to be a lot of volatility. We're going to see a bunch of 2 prints in inflation probably in the back half of this year, but I don't necessarily think that we stay there. So inflation volatility is what I expect. But there are cheap parts of the market outside of that. I'm very bullish on emerging Asia. I think Asian markets and the Asian economies are probably the most exciting growth story looking out over the next 10 years. And even China, as middle class, is going to be a main driver of that. It's going to grow an entire U.S. in terms of population over the next 10 years in terms of its middle class.
A lot of EM debt is denominated in USD, and so if the US dollar remains strong like it has all year, would that present a challenge from an investment standpoint?
Yeah, somewhat. In fact, it's even more of a challenge if you own emerging market local currency bonds, which unfortunately I do, and it's not the strong dollar hasn't helped me this year. But I do think that you bring up that asset class. I happen to be bullish on emerging market debt, particularly local currency, but it hasn't been fun this year to own them.
Okay, I understand. Well, great. Thank you very much, Peter. Where can we learn more about you and your work? I understand you're you're also the author of the book report.
So from a wealth management standpoint, they can go to bleakley.com and learn more about us and reach out if they want. If you want to read my daily missives, I now write on Substack, and you can type in my name at Substack and trial the book report. I write daily on all the macro and economic and market goings on that I think people should try out.
Okay, we'll put the links down below. Thanks very much, Peter. Appreciate your time.
Thank you, David. I appreciate having me.
And thank you for watching. Don't forget to like and subscribe and follow Peter Boockvar in the links down below.